The US 10-year at 3.25 year-end, bund yields rising another, say, 30 basis points to 1% by year-end, and a move on gilts as well. Michael, if that's the base case, and I don't know if it's your base case, but let's just say it's for higher yields, can you be bullish on the equity market at the same time if you grind towards 3.25 on a US 10-year?
I mean, I think you can no longer look at the equity market and talk about it as a holistic market. It's time to really talk about sectors.
So let's talk about the sectors that will do well. You're looking at the banks.
I like
the start of the year, get long value. I haven't seen it deliver over growth in a big way.
I'm not that bothered about the financials. I think everybody correlates those to interest rates too closely. I think it's commodity-related sectors. To me, we are in a very straightforward period of global growth with reflation attached. And commodity prices, I think, have already started to move higher and will continue to move higher and will not be affected by interest rates moving 25 or 50 basis points.
Jim Bianco, do you see that dynamic as well, a late cycle sector play on commodities, no damage done by higher rates?
Yeah, I definitely see that. We are in a late cycle, there's no doubt about it, and that you would expect that to happen. What you also have in the late cycle, too, as Troy brought up, is earnings are just through the roof. Earnings expectations are through the roof right now. Yeah. Wall Street is expecting 21% gains in earnings for 2018. Now, that just because they expect it doesn't mean it's going to happen. But if you wind up having the higher inflation expectations, pull that back down too, the market can have a double whammy. It's already priced in 21% earnings. If it winds up getting 15 with higher interest rates, that alone could be a problem for it.
Guys, I do want to get your view on cash right now and the opportunity cost of being in cash versus other asset classes or other assets full stop. About a year ago, it was very different. It's shifted markedly now. Whereas if the opportunity to be in cash, say, versus investment grade or 10 years, that's changed massively for me, Troy. And what does it mean for you? And I don't mean de-risk, go to cash because you're worried about the market falling through. I'm talking about being in cash versus, say, investment grade that doesn't yield that much better, but you're taking that extra risk.
Yeah. Well, I think what it means from a tactical standpoint is when you're going through periods of turbulence right now, you're more willing to sit on a little cash and let things flush through. Because what happens when you have these corrections is they tend to start out technical, and then as you get more information about what fundamentals are driving it, you can conclude which assets have been disproportionately punished for purely technical reasons versus fundamental reasons. So actually, it's interesting you bring it up because this may be one of the first months in a long time we sit on a little bit of cash waiting for things to shake out and see where there's principally technical dislocation. If you have, much lower cash rates, you're a little harder pressed to do that.